This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Capital gains tax is a tax on the sale of capital items that individuals pay. Now, it may be that a company will sell a capital item, such as a piece of land or a building. They also will have to pay tax on the gain that asset has made over its lifetime. But they don't pay capital gains tax. They pay corporation tax, and that is added to their taxable total profits, as we'll see later in the chapters that we are dealing with in this manual. There are 3 chapters regarding capital gains tax for individuals. Please will you watch them in the order they appear in the manual, because each chapter the next chapter builds on the information that was in the previous one. So if you watch the end chapter before this one, then it probably won't make a lot of sense. So please watch them in order. Now, for a gain to arise, we must have a chargeable disposal of a chargeable asset by a chargeable person. We're going to look at all of those individually in a moment, but the basic computation is simple. It is basically the proceeds that you receive less the cost of the asset in the first place. Now, that's in its basic form. That will give you a gain. Now, obviously, if it was that simple, then everybody would be able to do it. So it's not quite that simple, but that's the bones of it. That's what I want you, every time you have a capital gains tax computation to do, I want you to think, what are the proceeds? Have they been given to me, or do I have to work them out? Because that is sometimes the case. What is the cost of that asset? Now, sometimes, again, that is given to you, and sometimes you've got to work that out. And there are certain elements that we need to add in as well. But proceeds less cost equals gain. In companies, just a note on this, we will do it later when we do corporation tax. They get what's known as indexation allowance, and that's a relief for the effects of inflation. So let's look at these 3 things in a little bit more detail. What is a chargeable disposal? Okay, it's either the sale of whole or part of an asset. Now, if it's the whole asset, you will be given the proceeds. If it's part of an asset, you will be given the proceeds, but then you have to apply a rule in order to work out what part of it that's been sold. Also, assets can be gifted during lifetime, and that can give rise to a capital gain. It may also be lost and destroyed, in which case there will be insurance proceeds. And again, more rules as to how you will deal with that. Now, one very important factor to remember at this stage: no capital gains tax on death. Important, especially when we get to the inheritance tax chapter, because the 2 are linked. Because both inheritance tax and capital gains tax are related to capital assets. Now, chargeable assets, everything is chargeable unless it is specifically exempt. We've come across this concept before when we did income tax, where everything is taxable except things that are specifically exempt, such as the certificates from national savings institutes, things like that. This is the list of those assets that are specifically exempt. You will come across more than one of them, but there are some that come up more often. Cars regularly come up, particularly within company gains computations. Car, whether it's a valuable car, a cheap car, whether it's been bought because it's vintage, if it's a car, it is not subject to capital gains tax. Those certificates I mentioned, they are also exempt. Currency, decorations awarded for bravery only when you've earned it. So that could be football shirts or rugby shirts, gold medals from the Olympics, things like that. It could be medals you've won for bravery for war. If they're yours and you sell them, they are specifically exempt. However, people buy these awards and medals and trophies. If you've bought the trophy and then you sell it, then you will pay tax on it. Okay, these are decorations awarded for bravery where you have earned it, the person that's selling it. What else in there? I don't think there is anything else. Those are the ones that tend to come up most. Okay, but that's your list that you will need to remember. Now, what is a chargeable person? A chargeable person from your perspective is going to be an individual who is resident in the UK. You're not going to have to do trusts. You will have to do companies, and there may be partnerships, but that's individuals or companies, but you won't have to do anything else. So this is the basic pro forma. As with all pro formas, no, that's froma, that's spelt wrong. Let's do it again. Basic pro forma. There you go. I knew I could spell it correctly if I tried long enough. Okay, so the chargeable gain or allowable loss of an individual is computed. Remember that means worked out for each individual asset. Do not mix assets together, add the proceeds, take what? No, each one individually. All right. So the proceeds less the selling costs, which we will look at later, gives us the net proceeds less the cost of what you bought it for, will either give you a loss or a profit. So that's your basic pro forma. Proceeds minus cost equals gain. Okay, there are going to be extra rules, as I mentioned earlier. Now, what are the proceeds? Let's have a look at that situation, because it's not as simple as with tax. It's not as simple. The disposal considerations are proceeds, basically what you received for the asset, what you got for it. So that's the basic rule. However, there is always a but with tax. Market value must be substituted for what you actually got for it, where it's a disposal not at arm's length, i.e. it's a gift. So, arm's length, excuse my hand, okay, arm's length. Now, if I don't know you, that is how far you are allowed to come to me, arm's length away, all right? Because if I then sell you something, I have no connection with you, I will sell it to you at the proceeds and you will pay what it's worth. However, there are times when it says not at arm's length, that means I've allowed you in. That means I know you, which means I may be connected to you some way in family, relatives, spouse, that sort of thing. Now, if that's the case, you've probably had it for less than what it's worth. Or, I've given it to you. That can still give rise to a capital gain. If that's the case, you must use the market value. So be careful in a question if it gives you the disposal proceeds, if there is any, and the market value. Just check the question to see who are you selling it to. Okay, just be careful with that. So this is connected parties. It's called connected parties, close relatives and friends. Okay. So incidental costs, these selling expenses. Auctioneer's fees. So you sell something at an auction, you pay a percentage. That's an allowable cost. Estate agent's fees if you've sold a building, and any legal costs, they can be deducted. Now, one of the problems that we have with this disposal proceeds is when it comes to shares. Quoted shares on the stock market. So they're on the stock market. And it will say so in the question if you get it. Okay. Now, the problem you've got there with quoted shares is the prices go up and down all day long. Up and down. Therefore, how do we know what the price of that share was at the time that you sold it? So they have a special rule which allows us to work out a price for each share that you sold when it's quoted. So we've got here example number 1. Jenny gifted, okay, shares, 1,000 of them, when they were quoted at 400 to 408 pence. Now they're always done in pence, never pounds. That I know that's £4 and £4 and 8 pence, but you must always show it in pence. Very important that you always show it in pence. Okay. Now, the rule is it's calculated at the mid price based on the day's quoted prices. Those are the day's quoted prices. Okay. So you're looking at the mid price. So if we look at 400 and we add in 408, because that was the lowest price and that was the high price, and divide it by 2, what will that give us? Okay, that will give us 404 pence per share. So if she gifted 1,000 of them at £4 and 4 pence each one, or 404 pence, that is the disposal proceeds. So it's the mid price. So it'll look like that in the exam, quoted at 2 figures, add them together, divide by 2, that's the average of those prices. And that's per share in pence, and then you multiply that figure by the number of shares that were gifted. That's typical multiple choice section A question. So make sure you can do it. It's maths. And if you've got those numbers, it will come back to you. It will. So the rule is the mid price for that. So we've looked at proceeds received, if you get that. Market value if it's connected persons, and how to do shares. Proceeds. We've looked at some basic incidental costs. But what else are we allowed in this computation as a deduction? You'll notice in a capital gains computation that everything is deducted. You start at the top and everything comes off. So other things that you can have, other allowable expenditure that you can deduct from your net proceeds. So you basically what you paid for it. Now, if it was inherited, which might be the case, then it's called probate value. That will be given to you in the question. It's basically the market value at the date of the person's death. So if your great aunt gives you a large number of shares, then the value of those shares at the time of death, and that probate value will be given to you in the question, then that is what you will put in as the cost. And if it's a gift, then it's the market value at the date of the gift. Now, enhancement value is allowed. So if you buy an asset and you extend it, so if you bought a building, it's got to be new. Repairs don't count. Now, if you have done the property chapter, you'll notice that when you can claim expenses for property income, you can only claim repairs. Any capital items were not allowed in that income and expenditure account for rental income. That's because the capital items are deducted here. So here, any capital expenditure that you've made is allowed here as an expense. And a loss will arise if your expenditure is bigger than the proceeds that you've received. So each individual asset will have its own computation. Okay, so you may have done 1, 2, 3, 4. So you may have had assets. Ooh, I can't spell today, can I? Assets 1, 2, 3 and 4. You've done 4 capital gains tax computations, little ones. Proceeds less cost equals gain. Now, in order to work out what's happened in the whole year, you need to bring them all together. And this is the pro forma. This is the total gains pro forma. Okay, so all those individual assets that you've done pro formas for are all brought here together. Now, if one of them, so say that was a profit, that was a profit, that was a profit, and that was a loss. The loss goes there, and the 3 profits will go there, which gives us the chargeable gains in the tax year. You are then allowed an annual exempt amount. Okay, and that is in the rates. Never guess, always check, because it's slightly different than the personal allowance and you might get them confused. We don't want to do that. We're going all the way down this computation. The next one is the losses brought forward. So you made a loss in the previous year which you couldn't relieve, and that's been brought forward. We'll deal with that later. That gives us then a total taxable gain, and there are 4 rates depending on what you've sold. So that depends on what you sold and whether you are basic rate or a high rate taxpayer. Now note the order of the losses. In the year, first, brought forward second, and as I said, we'll talk more about that later. There's your annual exempt amount. Okay, if it's wasted, if you can't use it, you can't carry it forward, you can't give it to anybody else. The rates of tax, let's have a look at those. It depends on your income for income tax purposes. So a taxpayer's taxable income from his income tax computation is used as the basis to work out the relevant rates for capital gains tax. So it's either 10% or 18% if you're a basic rate taxpayer, and then it's 20 and 28% if you're high rate. So these are basic rate and that's high rate. Now, if you are working out capital gains tax for an individual and you've got to this point here, you may then have to divert back to the income tax to work out whether they are basic rate or high rate. Now that's become more common in the exams because it tests your ability to be able to do that. Okay. So if that's the case, then you need to work out the income tax position. Now never ever add income tax and capital gains together. Never. They are 2 separate taxes. We're using the income tax to work out whether somebody is at basic rate or high rate, because obviously if they're basic rate they pay at 10 and 18. If they're high rate they pay at 20 and 28, and that depends on how much of the basic rate band you've got left after you've done your income tax computation. So basic rate taxpayers take 10% on the gains falling within any unused basic rate band after you've worked out their income tax position, and then 20% on the excess. High rate and additional rate pay at 20%. Now, if it's a residential property, these are new rates. You pay at 18 and 28% and not 10 and 20%. As we go through the chapter, you'll see if we have residential property, it will be calculated in a slightly different column. Pro forma will look slightly different. And the tax is due to be paid on the 31st of January following the end of the tax year in which the gain takes place.